Over the past decade, shadow banking has grown from a niche market into a massive and largely unregulated sector that could now pose significant risks to the global economy. This documentary explores whether we are on the brink of another financial crisis, drawing parallels with historical events that led to economic turmoil. In recent years, shadow banks have flourished outside traditional regulatory frameworks, offering loans and investments to consumers and businesses alike. The opacity of these institutions makes it difficult for regulators to assess their health and stability. This lack of oversight has allowed shadow banking assets to balloon to over $100 trillion globally. As investors seek higher returns in a low-interest rate environment, they have increasingly turned to these opaque structures. However, rising redemption pressures and notable fund failures suggest that the sector is facing mounting challenges. The parallels with historical financial crises are striking. Take, for example, the 2008 financial crisis in the United States, where subprime mortgages packaged as AAA securities led to a collapse when Lehman Brothers went bankrupt on September 15, 2008. The U.S. government responded with a $700 billion bailout through TARP, Troubled Asset Relief Program. But it took 6 years for employment levels to recover from the peak of 8.7 million jobs lost. Another relevant historical event is the Great Depression that followed the stock market crash in 1929. The economy lost 30% of its GDP over the next 4 years, unemployment reached 25%, and 9,000 banks failed. This was partly due to the Smoot-Hawley Tariff Act, which worsened global trade conditions. New Deal programs attempted to stimulate recovery, but it took World War II spending to finally lift the U.S. out of its prolonged economic slump. These crises highlight a pattern. When financial systems become too complex or are inadequately regulated, they can collapse, leading to widespread economic pain and political instability. The human tendency to seek high returns without fully understanding underlying risks often exacerbates these situations. In shadow banking today, much like in the past with subprime mortgages or Weimar hyperinflation, there is a similar lack of transparency and risk awareness. For viewers today, the lesson from history is clear. Vigilance over financial systems is crucial to prevent economic crises. The opacity of shadow banks makes them particularly dangerous. Investors should be wary of products that promise high returns with little regulatory oversight, as these can often mask hidden risks. Regulators must also reassess their approach to ensure they maintain a comprehensive view of the entire financial ecosystem. The looming question remains, are we headed towards another 2008-style meltdown? While it is not inevitable, ignoring the signs and continuing business as usual could indeed pave the way for disaster. Understanding these risks and learning from past mistakes are vital steps in safeguarding our economic future.